Good morning, folks. Thanks for having me back. It was certainly a shot in the arm, albeit much needed. Management, they did come out yesterday with a little bit of swagger on the earnings call with a beat, top and bottom line, beat to net ads, especially encouraging to see that across regions. So UCAN, LATAM, EMEA, and APAC all performing strongly. I think that's driven by the strength of the content slate in the third quarter. They did a couple of nice things with Stranger Things, just stretching that out over Q2 and Q3. I think we'll probably expect to see a little bit more of that, given Netflix can flex some of that content spend by spreading it out. I expect to see more maybe mid-season breaks, and the slate looks really promising into the fourth quarter as well, which is also seasonally a very strong quarter for the business. Heading comfortably towards 250 million, a quarter of a billion in global paid subscribers. One of the concerns is obviously continuing dollar strength, given the makeup of the Netflix business. So much of that comes internationally. That is going to be a headwind, and I think that points to the guidance on both revenue and EPS in the fourth quarter being relatively low, much lower than consensus. But really, there's a lot to like here. Whether it's a sustainable inflection, that's unclear, but the frequency and the consistency with which the company is delivering hits continues to improve. The commitment that Netflix has made to that around about $17 billion in content spend, it's aggressive. It does throw down the gauntlet to its peers. Given that streaming enterprise is profitable on a free cash flow basis, it's tough. It's a tough act to follow. Bearing in mind, say Disney Plus as an example, on a standalone basis, that's not profitable yet. It's yet to be seen whether this is a sustainable inflection for sure, but a lot to like, and I think the ad tier, least of those, I'm sure we'll come on to as well.
Well, Dan, certainly a lot of interesting questions around the business model and what works best for the streamers. But as a sort of headline question, we're clearly facing a cost of living crisis, and the streamers haven't been put to the test yet as to how they're going to fare in a recessionary environment. What is your take on whether we're going to see the streamers, the likes of Netflix, prove to be an inferior good, something that people actually trade up to in a recession, or something that they trade out of as discretionary spending gets pinched?
I think it's a really interesting point. And I think this also means the ad tier is timed very, very nicely, actually. There are obviously always puts and takes to a cost of living crisis. People do become more cost conscious. They will be thinking about, do I need so many streamers as an example? But also I think what one has to consider is, staying in and entertaining yourself at home is actually, relatively cost effective as compared to going out and socializing with friends and what have you. So I wouldn't actually be surprised if there are, benefits associated with high inflation, because Netflix in and of itself represents a relatively cost effective way to remain entertained, even if that is staying at home. Not dissimilar to what we saw during the pandemic, but Netflix would be the primary beneficiary of that as the cornerstone of the streaming repertoire that the households on a global basis have been building out during the pandemic. So I wouldn't necessarily say it's all doom and gloom as a result of the cost of living crisis, and there could certainly be some potential positives to take out of it for a business like Netflix.